If you trade gold or you are thinking about trading gold, this video might save your trading account. Because the truth is this, most gold traders lose money, not just beginners. Even traders who have been trading for years still struggle with gold. They blow accounts, they overtrade, and they revenge trade. And sometimes they quit trading completely. But here's the interesting part. The problem is not gold. Gold is actually one of the best markets to trade in the world. The real problem is how most traders approach gold. In this video, I'm going to explain why gold destroys so many trading accounts, the biggest mistake gold traders make, the psychology behind gold trading losses, and how professional traders actually approach gold. If you trade gold, watch this video to the end because understanding these mistakes can completely change the way you trade. Mistake number one is treating gold as normal forex pair. The first reason most gold traders lose money is simple. They treat gold like normal forex pair. But gold is not a normal pair. Many beginners move from trading something like Euro USD or GBP USD and assume gold behaves the same way. It does not. Gold is much more volatile. Gold can move 50 pips in seconds, 100 pips in minutes, 300 pips in a few hours. And if major news hit the market, gold can move 500 to 1000 pips in a single day. This level of volatility is extremely dangerous if you don't understand how gold moves. Professional traders understand something very important. Gold is a fast market, which means if you use the wrong position size, if you use tight stop losses, if you enter randomly, gold will punish you very quickly. And that is why so many traders lose money trading gold. Mistake number two is over-leveraging. The second reason most traders lose money trading gold is over-leveraging. In fact, this is the biggest killer of trading account. Let me give you a simple example. Imagine a trader with a $500 account. Instead of trading small lot sizes, the trader opened a one lot position on gold. Now, if gold moves just $10 against the trader, that account could be wiped out. But here's the problem. Many traders don't realize how expensive gold is per pip. Gold moves very fast, which means large lot sizes can destroy accounts within minutes. Professional traders know something beginners don't understand. They know that gold requires smaller lot sizes, not bigger ones. In fact, during highly volatile periods like wars or major economic news, professional traders reduce their lot sizes even more because the goal of trading is not to make money quickly. The goal is to stay in the game long enough to become profitable. And if you use too much leverage trading gold, you will not stay in the game for long. So the third mistake is trading gold without understanding fundamentals. Gold is not just a technical market. Gold is deeply connected to the global economy. There are several major forces that move gold. The first one is interest rates. When interest rates rise, gold often becomes less attractive. When interest rates fall, gold tends to rise. The second factor is inflation. Gold is widely considered an inflation hedge. When inflation rises, investors often buy gold to protect their wealth. The third factor is the US dollar. Gold and the US dollar usually move in opposite directions. When the dollar becomes stronger, gold often falls. And when the dollar weakens, gold tends to rise. The fourth factor is geopolitical tension. Wars, global conflict, and uncertainties often cause investors to move money into gold because gold is considered a safe haven asset. If you ignore these factors and trade gold using only indicators, you are essentially trading blind. And blind trading almost always leads to losses. The fourth mistake is trading during news volatility. One of the fastest ways to lose money trading gold is trading during major news events. Events like Federal Reserve announcements, inflation reports, interest rate decisions, geopolitical crisis, war developments. These events can cause gold to move violently. Sometimes spreads widens, sometimes price spikes in both directions, and sometimes stop losses get hit before the real move begins. Many retail traders try to predict the news reaction, but professional traders usually do the opposite. They wait, they let the volatility settle, and then they trade the clear market structure that appears after the news. Patience is one of the most powerful advantages a trader can have. But unfortunately, many traders do not have patience, and gold punishes impatience very quickly. The fifth mistake is revenge trading. Another major reason traders lose money on gold is revenge trading. Gold moves quickly, so when traders lose a trade, they feel the urge to immediately get their money back. This leads to emotional decisions. For example, a trader loses one trade. Instead of stepping back, the trader opens another trade immediately, sometimes with an even bigger loss sizes. Then that trade loses again. Now the trader becomes even more emotional and the cycle continues. Before the trader realizes what has happened, the account is gone. Professional traders understand something very important. Losses are part of trading. Even the best traders in the world lose trades. But what separates professionals from beginners is emotional control. Professionals do not chase the market, they stick to their strategy. The sixth mistake is overtrading gold. Many traders lose money trading gold simply because they trade too often. Gold moves a lot and that movement creates temptation. Traders see candles moving and feel like they must always be in the market. But the truth is this, the best gold traders are extremely selective. They might take 1 or 2 trades per day, sometimes even 1 trade per week, because they wait for the best setup. More trades do not mean more profit. In fact, more trades usually mean more mistakes, and every mistake costs money. The seventh mistake is lack of a clear trading system. Another big reason traders fail with gold is lack of a consistent trading system. Many traders jump from strategy to strategy. One week they trade indicators, next week they trade support and resistance, and the following week they trade smart money concepts. Without consistency, it becomes impossible to develop skill. Trading is like any other profession. Skill comes from repetition and discipline. If you keep changing strategies, you never give yourself enough time to master one method. Professional traders understand this. They follow a system, they test it, they refine it, and they stick to it. The professional traders' approach to trading gold. Professional traders approach gold very differently. They focus on a few key principles. First is risk management. They never risk too much on a single trade. Second is patience. They wait for high probability setup. Third is market understanding. They pay attention to fundamentals, global events, and market sentiments. And fourth is discipline. They follow their plan. Even when emotions try to take control, this disciplined approach is what separates profitable traders from losing traders. Gold is not the enemy. Gold is actually one of the most profitable markets in the world, but it is also one of the most unforgiving markets. If you trade with emotion, over leverage, and no system, gold will destroy your account. But if you approach gold with discipline, patience, and proper risk management, gold can become one of the best opportunities in the financial markets. So the next time you trade gold, remember this. Your success in trading gold will not depend on luck. It will depend on how you manage risk, control emotions, and follow your strategy. If you found this video valuable, and make sure you like the video and subscribe to SmartRise TV, because on this channel we break down trading, finance, and wealth building so we can all grow together. And remember our slogan, succeeding together.